On July 24, 2001, real estate developer Larry Silverstein and his partners signed a 99-year lease for the World Trade Center complex from the Port Authority of New York and New Jersey. The massive deal, valued at around $3.2 billion, covered the iconic Twin Towers as well as several other buildings. As part of the lease requirements, Silverstein Properties had to secure substantial insurance coverage, a standard demand from lenders and the property owner. Just weeks before the tragic events of September 11, Silverstein, working with insurance broker Willis Group Holdings, put together one of the largest commercial property insurance programs of its time. The total coverage reached approximately $3.55 billion per occurrence. More than 20 insurers and reinsurers participated in a complex multi-layered arrangement. Because the lease was so new, formal policies had not yet been fully issued. Instead, coverage was bound through insurance binders and slips, documents that would later play a central role in a heated legal battles. Swiss Re was the largest participant, covering about 22% of the program. Other major players included Travelers Property Casualty, Lexington Insurance, Liberty Mutual, Alliance, and several more. The policies were written on an all-risk basis, which at that time automatically included terrorism as a covered event. Terrorism exclusions were not yet standard in the U.S. commercial property market. Silverstein insisted on insuring the properties for their full replacement value, even though the aging towers presented challenges like asbestos issues and lower occupancy rates. The premium for this massive coverage was substantial, reflecting both the enormous limits and the unique nature of the risk. Industry experts noted that Silverstein's team negotiated aggressively for the broadest possible terms. Then came September 11, 2001. American Airlines Flight 11 struck the North Tower at 8:46 a.m., followed 17 minutes later by United Airlines Flight 175, hitting the South Tower. The devastation triggered one of the most complex and contentious insurance claims in history. Silverstein quickly filed claims, arguing that the two separate plane strikes constituted two distinct occurrences under the policy. This interpretation could potentially double the payout to more than $7 billion. The insurers, led by Swiss Re, strongly disagreed. They maintained that the coordinated terrorist attack represented a single occurrence, limiting total liability to $3.55 billion. The situation grew even more complicated because many policies were still in binder form rather than fully issued documents. Different binders referenced varying policy forms. Some, including Swiss Re's, used the Wilprop 2000 form that clearly favored a single event definition. Others potentially followed different terms that might allow courts to treat the losses as two separate events. The dispute moved to federal court in the Southern District of New York. Multiple trials, appeals, and partial judgments followed. In one phase, a jury ruled that certain insurers were liable for only one occurrence. In another trial involving 9 other insurers, the verdict supported 2 occurrences for their portion of the coverage. After years of litigation, appeals, and negotiations, some involving high-level New York officials like then Attorney General Elliot Spitzer and Insurance Superintendent Eric DiNallo, the parties reached a global settlement in 2007. Insurers ultimately paid Silverstein Properties $4.55 billion. This amount exceeded the single occurrence limit but fell short of the double payout originally sought. The funds helped cover property damage and elements of business interruption. The broader insurance losses from 9/11 across all lines, property, business interruption, liability, life, and aviation, totaled an estimated $32 to $40 billion in 2001 dollars, making it the costliest insurance event in history at the time. This saga had lasting effects on the insurance industry. It exposed ambiguities in binder-based placements and the difficulty of defining occurrence in coordinated catastrophes. In response, insurers quickly added terrorism exclusions to commercial policies. The US government stepped in with the Terrorism Risk Insurance Act, or TRIA, in 2002 to provide a federal backstop and help stabilize the market. The case also highlighted the vital role of reinsurance in handling enormous losses and the long legal battles that often follow major disasters. The timing of the insurance placement just weeks before the attacks later sparked public speculation and conspiracy theories. However, contemporary reports stressed that securing the coverage was a contractual necessity directly tied to the new lease and financing requirements. The World Trade Center insurance story remains a fascinating and complex chapter in both insurance history and modern events. It reminds us of the intricate workings of high-stakes commercial insurance, the challenges of unprecedented catastrophes, and the importance of clear policy language in protecting all parties involved.